Smart money management with credit cards. Welcome back to Money and Credit Simplified. Today we're bringing you a comprehensive guide on smart money management with credit cards. We're going to master the art of using credit cards as powerful financial tools to build wealth, earn rewards, and manage cash flow efficiently in today's India. Credit cards aren't just payment instruments. When used strategically, they become wealth building tools that can actually make you money while providing convenience and security. But here's the catch. Most people use them completely wrong. By the end of this video, you'll understand the advanced strategies that financial experts use to turn credit cards into profit centers while avoiding debt traps. Let's dive into the smart money management techniques that can transform your financial future.
Golden rule. Don't treat credit as extra income. Let's start with the most important concept. Don't treat credit as extra income. This is the foundation of smart credit card usage. And getting this wrong leads to financial disaster for millions of Indians every year. Credit card reality check. Your credit card represents borrowed money, not free money. This seems obvious, but it's amazing how many people forget this basic truth when they see that available credit limit. Every rupee you spend on your credit card must eventually be paid back from your actual income. The credit limit is not your money, it's the bank's money that you're borrowing temporarily. Smart usage mindset. Here's the key paradigm shift. Use your credit card as a cash flow management tool to time your purchases strategically, not as a way to afford things beyond your means. The biggest mistake young professionals make is treating credit limits as bonus salary. They think, I have a 50,000 rupee limit, so I can spend 50,000 rupees more this month. This thinking leads straight to debt trouble. Remember this golden rule. Credit cards are tools for timing, not for spending more than you earn. They help you optimize when you spend your money, not increase how much you can afford to spend.
Understanding your credit card billing cycle. Now let's dive deep into understanding your credit card billing cycle. This is where the magic happens. Mastering your credit card's billing cycle is crucial for managing finances wisely and avoiding interest charges. It's not just about the due date, but understanding the entire timeline from your purchases to payment. Let me break down the four critical components. Statement date. This is when your billing cycle officially closes and your monthly statement is generated, listing all transactions for that period. This date is typically the same every month, let's say the 5th. Due date. The deadline for payment. RBI mandates a minimum of 20-21 days post-statement date, and Indian banks typically offer 20 to 25 days. So if your statement generates on the 5th, your due date might be the 25th or 30th. Grace period. This is the game changer, the interest-free window, typically ranging from 18 to 55 days. The length depends on when you make purchases within the billing cycle and varies between banks like HDFC, ICICI, and SBI. Here's the crucial insight. If you buy something on the day after your statement generates, you get the maximum grace period. If you buy it the day before statement generation, you get the minimum. RBI's 3-day buffer. An additional grace period of 3 days beyond the due date without late fees or negative credit reporting as mandated by the RBI. This is your emergency buffer, but don't rely on it.
Planning purchases around salary dates. Here's where we get strategic. Planning purchases around salary dates. This is the foundation of advanced credit card optimization that most people never learn. Let me walk you through a perfect example. Statement generation 5th. Your monthly statement is generated showing the previous month's expenses. This becomes your strategic window. Make purchase 6th. Here's the key move. Buy big ticket items immediately after statement generation. This timing is critical for maximizing your interest-free period. Interest-free period. Now you can enjoy up to 50 days without any interest charges. This is pure financial leverage working in your favor. Payment due 25th next month. Pay the bill after your salary is credited. You've essentially used the bank's money for free for nearly 2 months. Let me give you a concrete example. If your statement generates on the 5th and you purchase a 25,000 rupee laptop on the 6th, you have until the 25th of the following month to pay. That's nearly 50 days interest-free. This strategy gives you maximum cash flow flexibility.
You're essentially getting a free short-term loan from the bank while your salary earns interest in your savings account.
When to pay the bill. Payment timing strategy. Let's discuss when to pay the bill and why timing matters more than you think. Your payment timing directly impacts your credit utilization ratio and CIBIL score. Smart timing can boost your credit worthiness significantly, and here's exactly how to do it. Pay 3 to 5 days early. This is the optimal strategy. Paying 3 to 5 days before your due date improves your credit utilization ratio and gives your CIBIL score a healthy boost. Pay on due date. This is the safe approach that avoids late fees but provides no additional credit score benefits. You're being responsible but not strategic. Here's the pro tip that financial advisors charge thousands to teach. Banks report your outstanding balance to CIBIL before your due date, typically around the statement generation date. When you pay early, it shows lower utilization to credit bureaus, which they love to see. If your statement shows 10,000 rupees outstanding, but you pay 8,000 rupees before the reporting date, CIBIL sees only 2,000 rupees utilization instead of 10,000 rupees. This simple timing optimization can improve your credit score by 20 to 50 points over time, making you eligible for better loan rates in the future.
Minimum due is equal to debt trap. Now let's talk about the most dangerous feature of credit cards. Minimum due is equal to debt trap. This is where banks make their real money and where consumers lose their financial freedom. Understanding this is crucial for avoiding debt disasters. The minimum due trap, paying only the minimum due, typically 1,000 rupees on a 10,000 rupee bill, triggers interest rates of 30 to 45% annually on the remaining balance. Here's what most people don't understand. The interest doesn't just apply to the unpaid amount. It applies to your entire balance from the original purchase date. So that 9,000 rupees remaining balance starts accumulating compound interest immediately. Always pay total outstanding. Pay your complete bill amount to enjoy interest-free credit and maintain a healthy financial profile. This is non-negotiable if you want credit cards to work for you instead of against you. Let me show you the math. On a 10,000 rupee balance, paying only minimum due costs you approximately 4,500 rupees in interest annually. That's 45% of your original spending going straight to the bank. Always choose zero interest by paying the full amount. This single decision determines whether your credit card becomes a wealth-building tool or a debt creation machine.
EMI conversion, good or bad? Let's tackle a common question. EMI conversion, good or bad? The answer isn't simple. It depends entirely on how you use it. Let me break down the smart approach. Good EMI decisions. Big ticket electronics. Converting a 50,000 rupees laptop into 5,000 rupees monthly payments for 10 months with 0% interest makes perfect sense. You're essentially getting a free installment plan. Home appliances with 0% interest offers. During festivals like Diwali, banks often offer genuine no-cost EMI deals. These are excellent opportunities. Planned purchases that fit your monthly budget. If you were going to buy it anyway and the EMI fits comfortably in your budget, go for it. Items you genuinely need for work or lifestyle. Productive purchases that generate value justify EMI conversion. Bad EMI decisions. Small everyday expenses. Converting a 500 rupee pizza into EMI is financially ridiculous. The processing fees alone make it expensive. Impulse purchases you can't afford upfront. If you need EMI to afford it, you probably shouldn't be buying it. Items with high interest rates, 15% plus annually. These defeat the purpose of smart money management. Converting existing balances into EMI. This usually comes with additional fees and extends your debt period. Key insight. EMI conversion works best for planned high-value purchases with low or zero interest rates. Avoid converting small amounts as processing fees often make them expensive.
Using credit cards to save money. Now let's explore the exciting part. Using credit cards to save money. This is where credit cards transform from payment tools into wealth-building instruments. Here's how to make your spending profitable. Cashback on shopping. Earn 1 to 5% cashback on groceries, online shopping, and dining. Popular cards like HDFC Millennia offer 2.5% cashback on online purchases. Think about it. If you spend 50,000 rupees annually on online shopping and earn 2.5% cashback, that's 1,250 rupees back in your pocket. This is free money for spending you do anyway. Travel rewards. Accumulate reward points for free flights, hotel stays, and travel vouchers. Convert everyday spending into dream vacations. Many premium cards offer 2 to 4 reward points per 100 rupees spent. These points can be redeemed for travel worth 25 to 30% more than their cash equivalent. Fuel surcharge waivers. Save 1% fuel surcharge up to 500 to 1000 rupees monthly on petrol and diesel purchases at authorized fuel stations. For regular commuters spending 5000 rupees monthly on fuel, this saves 600 to 1200 rupees annually. Significant money that adds up. EMI offers on gadgets. Access exclusive no-cost EMI offers during sale events like Diwali, Amazon Great Indian Festival, or Flipkart Big Billion Days, saving thousands on electronics and appliances. Strategic insight. The key is choosing the right card for your spending pattern. A fuel-focused spender should prioritize fuel benefits, while online shoppers benefit from e-commerce cashback cards. Match your card to your lifestyle.
Actions that void grace period in India. This is crucial knowledge. Actions that void grace period in India. Understanding these critical actions is essential to protect your interest-free credit period and avoid unnecessary charges. Most people lose their grace period without realizing how. Carrying a balance. Any unpaid balance from previous billing cycles immediately cancels the grace period for new purchases. This is the most common way people lose their interest-free benefits. Once you carry a balance, every new purchase starts accumulating interest from day one until you clear all outstanding amounts. Cash advances. Interest starts accruing from the day you withdraw cash, as cash advances never have an interest-free period. Avoid cash withdrawals through credit cards unless it's an absolute emergency. EMI conversions. Converting a purchase to EMI during the billing cycle can sometimes void the grace period for other transactions, depending on your bank's policy. Missing full payment. Failing to pay the total outstanding amount by the due date results in interest being charged on your entire balance from the date of purchase, not just the unpaid portion. Partial payments. Only paying the minimum amount due or any amount less than the total outstanding eliminates the grace period for that cycle and potentially the next cycle too. Recovery timeline. In India, banks typically require 2 to 3 consecutive months of full payments to restore your credit card's interest-free grace period benefits. This means one mistake can cost you the grace period for 3 to 4 months total, an expensive lesson in the importance of full payments.
Profit from interest-free period. Safe hack. Here's the advanced strategy. Profit from interest-free period. Safe hack. This is a legitimate, risk-free method to generate additional income using credit card float. It's perfectly legal and safe when executed properly. Step 1. Use card after billing date. Make all major purchases immediately after your statement generation date to maximize the interest-free window. Step 2. Park salary in a high-interest account. Keep your monthly salary in a high-yield savings account or short-term fixed deposit earning 4 to 6% annual interest. Step 3. Earn interest while spending. Your money earns interest for 45 to 50 days while your credit card covers your expenses. You're essentially using free money while your capital generates returns. Step 4. Pay before due date. Transfer money from your interest-earning account to pay the credit card bill, keeping the earned interest as pure profit. The numbers. On a 1 lakh rupees salary at 4% annual interest rate. Monthly profit, approximately rupees 300. Annual benefit, 3,600 rupees in free money earned through smart timing.
This strategy turns your credit card's interest-free period into a profit-generating tool while maintaining zero debt. It requires discipline and systematic execution, but the returns are guaranteed and risk-free. The key is never spending beyond your means and always having the full payment amount earning interest in your account.
Smart Credit Card Checklist. Let's create your Smart Credit Card checklist for optimal money management. Don't overspend. Stick to your actual income capacity and treat credit as borrowed money, not bonus salary. This is the foundation of smart usage. Align purchases with billing cycle. Time big purchases right after statement generation for maximum interest-free period. This single habit can save you thousands annually. Pay 3 to 5 days before due date. Boost your CIBIL score by showing low credit utilization to rating agencies. This improves your future borrowing capacity. Convert only big-ticket items into EMI. Use EMI for planned, high-value purchases with 0% or low interest rates. Avoid small amount conversions due to processing fees. Maximize cashback and rewards. Choose cards aligned with your spending pattern and redeem rewards regularly. Don't let points expire. Convert them into value consistently. Park salary for free profit hack. Earn interest on your salary while enjoying interest-free credit card benefits. This advanced strategy generates passive income. Monthly review habit. Analyze your credit card statements to ensure you're maximizing benefits and maintaining healthy usage patterns. Set calendar reminders for bill payments and reward redemptions. This checklist ensures you extract maximum value from your credit cards while building long-term financial health.
Master your financial future. Let's talk about mastering your financial future with credit cards as strategic tools. Here's the key insight. Credit cards are powerful money tools if you manage them smartly. Use these strategies to save, earn, and build your financial future. Build credit score. Smart usage patterns improve your CIBIL score for better loan rates in the future. A high credit score can save you lakhs in interest over your lifetime on home loans, car loans, and business financing. Earn while spending. Convert regular expenses into rewards, cashback, and interest earnings. You're essentially getting paid to spend money you'd spend anyway. Financial security. Emergency credit access and fraud protection provide peace of mind. Credit cards offer superior fraud protection compared to debit cards, and the credit line serves as emergency liquidity. The compound effect of these benefits is remarkable. Smart credit card users often save 10,000 to 25,000 rupees annually through cashback, rewards, and interest optimization while building superior credit profiles. Remember, the difference between wealth builders and debt sufferers often comes down to how they use credit cards. Same tool, completely different outcomes based on strategy and discipline.
Conclusion and call to action. Smart credit card management isn't just about avoiding debt. It's about turning everyday spending into wealth-building opportunities. The strategies we've covered today can save you thousands annually while improving your credit profile and providing enhanced financial security. But remember, these techniques require discipline and systematic execution. Ready to dive deeper? Coming up next, best ways to use rewards points in India, where we'll discover how to convert your everyday spending into free flights, hotel stays, and valuable vouchers that can fund your dream lifestyle. If this comprehensive guide helped you understand smart money management with credit cards, please hit the like button and subscribe to Money and Credit Simplified. We're building a community of financially smart Indians who use these advanced strategies to build wealth systematically. Your subscription helps us create more detailed guides like this one. Hit the notification bell so you never miss our practical money tips and advanced financial strategies. Let's make finance simple, together. Your journey to financial mastery starts with smart credit card usage, and you now have all the tools you need to succeed. Thank you for watching, and remember, every rupee spent smartly is a step toward financial freedom.